So today we'll be starting with basically efficient market hypothesis. This is basically chapter 1 of CM2. It's a theoretical chapter. There aren't any numericals as such in this chapter. On the face of it, chapter is a very short one. Like if you'll take a look at the number of pages in the material, it's close to like 15 or 20 only. But to get the essence of it, what we are trying to do over here, it might take a bit of time. More clarity, I would say, will come once start practicing the questions, let's say, which are there at the end of the material, as well as the past in questions. So to give an essence of what we are trying to do over here is we are gonna observe the capital markets, or more precisely the stock markets, and then we are going to check whether these markets are operating efficiently or not. When I say efficiently, I would be defining what do we mean by efficiency over here. We would then see that there are different forms of efficiency, and then we will see that how to test whether a particular, let's say, stock market is a particular form of efficient or not. So let us begin with what we have under efficiency. So in the introduction, what we have is an efficient security market. Note that stock market, security market, these are interchangeably used. An efficient security market is one in which the price of every security fully reflects all available information and hence is equal to its true investment value. This might look a bit arbitrary when I say that the price of every security fully reflects all available information and hence it's equal to its true investment value. See, in practice or even in theory, we do not really know what is the true investment value. Depending on the assumptions used, depending on the analysis performed, different, let's say, individuals could come up with different true values. So right now, you can just think of it to be a hypothetical construct that there is, let's say, one true investment value for the price of a particular stock, and a security market would be efficient if that the market price of that stock is equal to this investment value. Obviously, in reality, this isn't the case, and we will would be seeing shortly how do we go about testing this, what are the challenges we observe while testing these, and so on. So according to the efficient market hypothesis, security markets are efficient. Now there are three forms of efficiency which we are going to look at. These are precisely weak form, semi-strong form, and a strong form. So to give you an idea, what does weak form mean? Weak form means that whatever are the prices of the security, those are incorporating all past information. Alternatively, market prices reflect all of the information contained in historical price data. What exactly do we mean by this? We would be looking at it shortly. Then what we have is the semi-strong form. Market prices reflect all publicly available information. And finally, what we have is a strong form, which is nothing but market prices reflects all information, whether or not it is publicly available. So a couple of you might know that there is something called, let's say, information which is publicly available. These would be on the basis of financial documents or announcements released by company on the stock exchanges itself. Alternatively, there are certain informations which only few managers of the company would be knowing. So basically what I'm referring to is something called insider information. That is the key managerials of the company, or very few people would be aware of this. After a point of time, obviously a lot of this information would be made publicly available, but for certain amount of time, this could be known to certain individuals only. So these are the three forms of efficiency which we will be looking at. We will look at, when I say a market is a weak form efficient, what do we mean by that? Next, how can I test that? And then in practice, the stock markets which we see, whether it's in our country or in various other developing or developed countries, which form of efficiency do they have? Now, before getting into this, the whole point is when we are going to say that a particular market is, say, XYZ efficient or not. The emphasis, although the whole essence is keep whether using certain techniques you can generate higher risk adjusted returns. So here, first of all, you need to realize that different individuals would be having, let's say, different returns, would be experiencing different returns. If somebody inherently takes, let's say, higher risk, then there are obviously chances that he or she would be getting higher returns. So here, my task is not to achieve just higher returns. What we are going to look at in this entire chapter is whether an investor, through certain techniques, systematically, let's say, experience high risk adjusted returns. If that is the case, in that case the markets won't be efficient, and if somebody cannot systematically generate higher risk adjusted returns, then we can say that yes, the markets are efficient in nature. So this, we'll go through this next section as well. The importance of the market efficiency derives from the fact that if markets are inefficient, then investors with better information may be able to obtain higher investment returns. If, however, markets are efficient, then it is not possible to identify under or overpriced securities, which can then be traded to generate excess risk adjusted returns. Another thing which a few of you might find a bit, let's say, non-intuitive or might be surprised is, generally, you all tell me, how can we make profits in a stock market? What's the general way to make profits in a stock market? You buy something at, say, whatever price, and then you sell it at a higher price. This is the usual convention we think of. If you buy a stock, hopefully the prices of that will increase, and then we can sell it to make a profit. You can, in financial markets, you can sell things before even buying it. Now again, intuitively you might think that, how can you sell something which you do not possess? In stock markets there are certain instruments which allows you to sell a particular, let's say, share without actually even owning it. So another way to make money is you sell something first. When would you sell that? If you, let's say, expect that the prices are going to decrease in future, and then you buy back at a later date, and in this way also you can make profits. So that is one thing. Again, when we would be looking at later chapters, let's say from chapter number I guess derivatives onwards, we would be looking in more detail what do we mean by buying an asset, selling an asset. There's a specific term called short selling, which is basically selling something which you do not have. So normally, let's say if you have shares, you can think of this way as well. Let's say you inherited certain shares, say of company ITC, which is Indian Tobacco Company. Now, you think that going forward, there are going to be a lot of taxes imposed by government on tobacco products. Then, due to other environmental, or other investment factors, these sort of companies may not be performing well. So maybe you sell the shares of this company, let's say at a price of 260 rupees. Okay, that's the price probably in the last week or so. And let's say after a month, you see that the prices are 200 and you again buy them at 200. So you in your mind might think that, I have made a profit of, let's say, rupees 60 per share, because your benchmark was what? You sold it for 260, you bought it back for what? 200. Although you are still what? Holding the shares only. So again, you also need to take a look at the point of reference. If your point of reference was, the price at which the shares were first actually bought, which maybe your parent or grandparents might have bought it, then that would have been, let's say, the cost price, and then the price at which you're selling it today will be the selling price, and the difference will be profit. Another way to view it is ki after selling it, you buy it at a lower price again, and then you can just visualize ki beforehand also I had shares, now also I have shares, but I have made a trading profit of rupees 60 per share. So here you are able to sell because you already had the shares. What I'm trying to say is, even let's say I do not hold shares of a particular company, I can go and sell them and then buy them at a later date. So again, this is something which is restricted. Very few investors do. Again, certain stock markets even do not allow this at times of market crash, or during any sort of economic turmoil. The stock market exchanges might put restrictions wherein you cannot sell something which you do not have. At least in Indian markets as of now, you are allowed to sell securities which you do not have. we would be seeing, there is something called a cash market, derivatives market. We would be discussing that later. So for the timing, just to get yourself accustomed with the idea, to make profits, you just do not need to buy something and then sell it at a higher price. There is alternative way, which is you sell something and then you buy it at a lower price. And second thing is, all we are going to look at is risk adjusted returns. Again, we would not be in a position to develop any mathematical models, to give a quantitative measure, how much risk we are taking right now, how much risk adjusted returns we are getting. Just let's say, I would say a terminology which we are using to, let's say, comment whether a particular stock market is, having some form of efficiency or not. So this chapter efficiently, does two things: describes the three definitions of market efficiency. Along with that, we would also look at, certain investing techniques. Primarily, two. One we call passive investing technique. Second is what we call active investment technique. And then what we have is discuss the evidence for and against the different forms of the efficient market hypothesis, which turns out to be largely inconclusive. Now, progressively as you go towards the higher actuarial papers, or even, in the initial set of papers, let's say certain parts of CM2 as well as certain parts of paper CB1, questions which would be asked will not have a answer which is only yes or a no. They would be in between. You might give arguments for something or against something. As long as your arguments are correct, you would be getting appropriate marks. These are not black or white things, this has to be correct or this has to be wrong. So even after covering this chapter, we won't be in a position to conclude that, let's say, whether a particular stock market is efficient or not. There would be certain examples which would highlight that yes, these markets look efficient. Then we would also be experiencing certain examples which, says that no, the markets are not the markets are not efficient. So there's a particular PDF as well, so this handout is something I would be, sharing with all of you. This effectively covers all the underlying concepts covered in the chapter 1 itself. Again, you should all, just take a look at the material. This PDF will just serve you to, in a compact way, you will get all the main pointers, and it might become a bit easier for you to understand, what we're trying to do over here. So now to get into market efficiency, first looking at, strong form EMH. So, okay, this is testing, sorry. Coming to know three forms, what do we mean by these forms? In strong form, this, basically states that the prices incorporate all information, both publicly available as well as only available to insiders. Alternatively, you could use the term privately available information. Semi-strong form EMH states that the market prices incorporates all publicly available information. Now just see how we are going with the hierarchy. The strong form basically encompasses what? All available information. Keep in mind, I'm talking about all available information as of date. It could be that in future certain new information comes in. So obviously the market, like let's say today on what's the day today? On 17th May, the prices are reflecting all known available information today, whether privately held or publicly held. If a new information comes, which might be new to the insiders as well as the outsiders on 19th May, then obviously, the stocks would be reacting to that news as well. We are not right now commenting on the future news. We are just commenting on all the news and information available as of today itself. Yeah, I would be sharing the PDF. Siddhi, you have a doubt? Go ahead, ask a doubt.
Yes, so when we talk about markets are a very subjective term. So when we say that the market is in a strong form or a semi-strong form, are we talking about the market of say a particular stock or the entire stock market as a whole?
We are right now commenting about the entire stock market. So not just, let's say, one particular stock, but let's say in India, we have two exchanges primarily. One is the National Stock Exchange. Second is the Bombay Stock Exchange. You could also just think them to be stock exchange, equity stock exchange, We are talking about that only, not any particular share as such.
So if we want to, these three forms, strong, semi-strong, and weak, they won't apply when we talk about individual companies or say an industry as a whole.
No, we apply this to the entire stock market. See, again, the whole thing is regarding the securities market. So the moment I use the term market, it is encompassing all the stocks which are trading in the market. Again, we would be taking examples of selected stocks to make certain inferences, but that would be used to make an inference on the entire market.
Okay.
And here market is defined as basically, let's say, the stock market.
Okay.
Right now. So now we started with all sort of available information in strong form. In semi-strong form, we are looking at only publicly available information. And now in weak form, the market prices incorporates all information contained in the price history of that investment. So when I talk about public information, a part of it relates to what? The historical price of the particular security. So later on, we would be seeing that if a particular market is strong form EMH, it automatically implies semi-strong and weak form. If a market is, let's say, semi-strong form EMH, it automatically implies weak form EMH as well. So that is again the conclusion we have written over here. Now next coming to investment techniques. You will see three over here: insider trading, fundamental analysis, technical analysis. Note that there is insider trading is not an investment technique. It is, we will shortly define it. It is banned in most of the markets itself. So insider trading basically refers to the act of certain let's say managerial people or certain key personals trading in the stock market on the basis of information which is only privately available, which hasn't been publicly made available. So this is something which is restricted in most of the stock markets. So here the how do these people make advantage of this fact? Let's say you are the CFO of a particular company. You are about to disclose the financial results, let's say in a week or so. You observe that the company's financial performance has been very good this time, and you expect that investors or the stock market should be reacting to it positively. So right now, this information is not, this hasn't been made publicly available. Just because you are, let's say, the CFO of a company, you know the results before they are made publicly available. What you could do is you could buy shares from the market itself. Once the results are declared, it is expected that the stock prices will increase and then you can sell it. This act is basically nothing but referred to as insider trading. Now, keep in mind, let's say if you are CFO of a company, you can still buy the shares of the company and sell it. There is no restriction in that. There are just certain periods or durations when you cannot do this. So let's say the trading window is closed during certain points of time. Whenever, let's say, the company's financial results are to be released, let's say during a 2 week to 4 week window, all the key managerials of the company are not allowed to trade in the market. Whether these are key managerials, their immediate family members, and theoretically speaking, anyone should not be able to let's say trade in the stock market using that particular information. Any one of you aware about Rajat Gupta? Rajat Gupta was his name, or am I missing him? Basically, there was this person who was jailed. He was of Indian origin only due to an insider trading case. So the allegation against him was that he had passed on certain information to one of his Sri Lankan friend, or rather a broker, not a friend exactly. And using that information, this particular Sri Lankan individual made a hell lot of profit. So although he denies that he didn't pass on that information purposely, it was just as a normal conversation itself. So this particular individual, he was a very renowned banking veteran, and he was jailed for a couple of years for this particular act. So so insider trading is again basically, let's say if hypothetically I'm the CFO of a particular company, I know certain things about the results. If I pass this on to anybody, be it my family members, be it to my friends, be it to any other individual, so that this individual can benefit from it, technically that isn't allowed. So the moment you pass on certain information which anyone uses to make, let's say certain profits, that is something which is not allowed in most of the markets. Even in Indian markets, insider trading is banned. Next, what we have is like a actual investment technique, which is fundamental analysis, which basically does what? It looks at the finance of the company, a lot of figures, be it the revenue, sales, profitability, lot of other metrics like return on equity, return on capital employed, so on. If you would have studied in accounts, you would have come across these terms. Else in CB1, these are held in more detail. So fundamental analysis is basically analyzing the balance sheets, profit and loss statement, so on, to come up with a suggestion whether, let's say, we should be investing in a particular share or not. So there are various ways. One way, if you would be aware of, is looking at the book value. So book value tells us if today we sell all the assets of the company and and pay off all the liabilities, what is the amount being left? So you can just think in a very crude way that if I say the book value of a company is 100, that is for each share you are holding. If today, let's say the company is liquidated, all the assets are sold off, and all the liabilities are cleared, you would be left out with how much? 100 rupees per share. So now, different stocks coming from different industries trade at different multiples. Certain industries, which are, let's say, for example, software services, these generally tend to have high price to book values. That is, if their book value is say 1, then generally the market prices could be, let's say, 5, 6, 7, 10, 20, anything. Industries to do with manufacturing, these generally tend to have, let's say, low book values. So again, I'm not getting into why the reason for a certain companies having high book values or low values. So that is a different aspect itself. The point is that if I think that for a particular stock, the fair, let's say, metric should be 2 times, the market price should be 2 times the book value. Say the book value as per the current set of financial accounts is 100. Now, if the market price is 150, and if your basis or analysis, you estimate that it should be 200, in that case, what you would be suggesting that you should buy this particular share because you feel that this is not fairly valued. You feel that it should be valued at 200 rupees, whether the current price is 150 only. This is one way. There are other ways as well. You could be looking at, let's say, the price to earnings ratio, so on. More specifically to the insurance concept, if you're trying to value insurance companies, so you generally use a term called embedded value. Some of you might have encountered this in CM1, although it's not covered at all in paper as such. If you have solved, let's say, past papers of IAI, you would be looking at questions mentioning embedded value. So if I want to basically look at valuing insurance companies, then looking at the embedded value is the right metric. So, for example, recently the LIC IPO had been launched. In fact, today was the listing date. So, the embedded value of LIC was roughly 5.4 lakh crore. If I look at the other listed companies in the Indian stock exchanges, be it, let's say, HDFC Life Insurance, or we have ICICI Prudential Life Insurance or SBI Life Insurance, let's say these are trading at a multiple of 2 to 3 times its embedded value. So let's say if the embedded value is 100, then these stocks were trading at 200 to 400. In case of LIC, it was coming out at a multiple of 1.1x only. So it was having a market cap of 6.1 lakh crore approximately against the embedded value of 5.4 lakh crore. So certain analysts felt that this was, let's say, very attractively priced. When I say attractively priced, it's just a nice way to say maybe the thing is underpriced. So a lot of them suggested, you should go and buy the particular, let's say, the initial public offering. So this is just another way, this is again a part of fundamental analysis. Basis any particular financial metric, you can come up with, whether the company is overpriced or underpriced and then make a recommendation. Finally, what we have is technical analysis, which is basically to do with studying the the chart patterns, more precisely the historical price data as well as the volume data. Price data is the how the price of a particular security is changing. Volume is basically the number of shares which is being traded. It could be on a daily basis, on a 10-minute basis, on a monthly basis, quarterly basis, so on. So basically it is looking at the past data points. Using this, they try to come up with certain trading techniques in future which help them to make certain profit. So I'll just draw a particular graph and let's whether you can comment something on it. So this is time, and on the y-axis we basically have the price of a share. Now looking at this graph, tell me what things can you observe? Or looking at this graph, let's say you are standing over here. This is today basically. You have the price history. Now looking at this, can you suggest what should you do? Do you expect the prices to increase, decrease, or so on? Increase, right? What do you look? Try to describe that. See if you can find any sort of pattern, anything over here. Cyclic pattern. If you will look at here, one high, this could be termed as a hump, one hump, two hump, third hump, and then you see a sharp fall. One hump, two hump, third hump, again a sharp fall. One hump, two hump, third hump, again a sharp fall. So next, if we think that the past will continue in future, then we expect that after a fall, whenever it stabilizes, it will start increasing only. Similarly, let's say if instead of this time was today, you were standing at, let's say, here, you could still think that there's gonna be a slight decrease expected, and then you expect a larger increase. If you'll observe one more thing, all these tops which are being made, these are higher tops. This one is higher than this one is higher than this one higher than this one higher than the previous one. So this is referred to as basically higher tops, and it suggests your stock is having a very strong up movement. So again, you are looking at here one higher top, two higher top, and then a third higher top. So these are just different sort of patterns. Again, there are a lot of ways to analyze the data and all. So my point is, looking at the price history, I can develop a trading technique. So I will be looking at the charts on the basis of that. This is a very simplistic way. At this point of time, I can think that okay, the prices are gonna increase in future. So let me buy this particular share, and later on I will sell it when, again, the best way, if the things happen the way that happened in past, I shouldn't sell it the moment, let's say, this increases to this. Maybe it will decrease again, it will again go back, and go back a bit more higher, then again it might decrease and again it will go back higher. So I should be ideally selling it assuming things happen the way they have been happening in the past, when it is hitting a top for the third time. Again, timing this is not easy. You might sell it somewhere here or somewhere here, but the fact is you should not be selling it in the first two tops. Again, this is all on the assumption that whatever has happened in the past will be happening in future as well. In reality, that is not always the case. So this is how we basically come up with a trading algorithm, or we use technical analysis. There are other ways as well. Again, let's say if I want to take another example, we draw another graph. This is again same. On the x-axis we have time, on the y-axis we have the price of the security, and this dotted line just shows this is, let's say, the mean value over the year. So if you'll again take a look at this, and let's say this is time 0, and let's say this is time 20, and we are working in years. So you will see that over the past 20 years, the stock prices have remained almost stagnant itself. It has increased and decreased in certain phases, but overall it has remained stagnant only. So there are certain stock prices which for the past couple of years have broadly remained in a particular range. So how you can develop trading strategies for this is whenever the stock price increases next, you could look to sell it. And if let's say the stock price decreases, you could look to buy it, because you would expect that the stock price is mostly in a particular range. So if you're at the lower end of this range, it would be let's say more better to buy it, and if you're at the higher end of the range, you would prefer to sell it. Again, this is all assuming what, if the prices continue to remain in this particular range. So just one example was Reliance Industries from 2008 to 2017-18. It was at a particular level only. Post 2017-18, once they had basically after Geo itself, it had started to increase, and it probably increased by 2 to 3 times in the next 2 to 3 years itself. So again, the whole point is when we come up with a technical analysis, we assume something. It might not be true, that will eventually happen, but these are just the ways to look at the charts and then to come up with trading strategies. And we will see that technical analysis will be correlated to my weak form EMH. Fundamental analysis would be basically connected to the semi-strong form. Insider trading is not a technique as such, but that is something which we would be looking with the strong form EMH. Now, next thing which we are going to look at is, testing the efficient market hypothesis. Or let's, before that, we should probably take a look at this, when I say that stock markets are weak from EMH, then how do I expect it to react to a particular set of news, or, which things work or does not work when a market is weak from efficient. So this is the key thing in a very crisp format. The market price of an investment incorporates all information contained in the price history of that investment. Knowledge of a stock's price history cannot produce excess performance, as this information is already incorporated in the market price. This form, if true, means that technical analysis techniques will not produce excess performance. So the statement is, if a particular market is weak form efficient, then using technical analysis, you cannot generate higher risk adjusted returns. Note that you can generate higher returns, but this will be only if you take higher systematic risks. So is this thing clear? This is the one important interpretation, that if markets are weak from EMH, then using technical analysis, we cannot produce higher risk adjusted returns. See that if you're being able to understand why that is the case, the moment I say the markets are weak from EMH, it means that security prices are incorporating what? All the historical price information. So if the prices are already incorporating all the historical price information, then using that historical price information, I cannot generate any higher risk adjusted returns in future, because my current price has already incorporated all of that. Next, what we have is semi-strong form EMH. The market price of an investment incorporates all publicly available information. Knowledge of any public information cannot produce excess performance, as this information is already incorporated in the market price. So, this form, if true, means that fundamental analysis techniques will not produce excess performance. Whenever you're looking at balance sheets, financial statements, or any other information about a particular company which is available in public domain, so everyone has access to it. I am assuming that the market is semi-strong from EMH, means the current prices are incorporating all sort of available information. Then just by performing our own fundamental analysis, you cannot generate higher risk adjusted returns. Again, it could be that certain individual, by virtue of having very high intellectual knowledge, or knowledge of studying the stock prices and all, or the balance sheet, might be able to generate. Here what we're looking at is systematically, and not for just 2, 3, 5, 10 years, maybe for 20, 30, 40 years consistently, using a particular fundamental analysis or any analysis, being able to generate higher risk adjusted returns. In our day-to-day life, we might even think, 2 years, 3 years is a very long-term nature. But in this particular context, when I say being able to consistently generate systematically, higher risk-adjusted returns, this could be, let's say, for a 20-40 year period, because it might take that amount of time to experience different market conditions. Say, for example, if you would have been following the, the financial markets of late, for the past 8 or 10 years, we were in an environment where the interest rates were extremely low around the world, be it US, be it European countries, be it Japan. The interest rates in certain countries were negative as well. And apart from that, they were extremely low, between, let's 0 to 1%. Historically, they have tend to be higher only. In India, again, it was in the range of, let's say, 6 to 8%. In the past 4 or 5 years, it had decreased to, let's say, 4 to 6%. And again, now inflation is starting to increase, so it is expected that the interest rates will also increase going forward. So the whole point is, for the last 10-12 years, most of the individuals, would have only seen a market where, the interest rates were low. The way any asset class behaves in a low interest rate environment is extremely different, in a high interest rate environment. So a lot of them, let's say, ones who have been into the market for last 10-12 years, they might have been able to, consistently generate high returns. But a part of it could be attributed to the fact that it was a low interest rate environment. Now, if I have a high interest rate environment, then using the same techniques, will they be able to generate, these high adjusted, returns or not? So that is the case over here. So again, we would be looking at here, just because one individual does it or there is one outlier does not mean, a particular efficiency does not hold or it does hold. What we are looking at is a various set of examples, and if there is a large, let's say, concrete evidence, a particular thing is observing, we tend to, conclude towards that. You will have other examples as well, which would be suggesting elsewise. So we need to take it in the we need to take it in its entirety, not just take one or two examples to, prove or disprove certain thing. Next, what we have is strong form EMH. The market price of an investment incorporates all information, both publicly available and also that available only to insiders. Knowledge available only to insiders cannot produce excess performance, as this information is already incorporated in the market prices. If a particular market is strong for EMH, then, even resorting to insider trading will not help you to generate higher risk adjusted returns. Stock markets around the world are subject to regulation. Often rules exist to prevent individuals with access to price sensitive information, which is not yet public, from using this information for personal gains. For example, senior management involved in merger and acquisition talks are often banned from trading in the stock of their company. Such rules would be unnecessary if the strong firm efficiency held. So one thing which, you can interpret is, any market which has banned insider trading, it automatically implies that particular market will not have been strong form EMS. Because if a particular market would be having strong form efficiency, then there is no reason to ban insider trading, because using insider trading, somebody cannot make higher risk adjusted returns. So you can actually, conclude this, for all the markets around the world. Most cases, in most of the developed markets and even in the developing countries, insider trading is something which is banned. In case it is not banned, it does not mean that, it is a strong form EMS. It simply could mean that the particular country does not have a very developed financial market or very strong financial market, where the, let's say, the consumers are being protected from, certain market participants who do not, let's say, work in a very ethical way. So this is regarding strong form EMH. Next, what we could look at is relationship is something which we have already looked. Next, what we will try to cover is something called a active investment management or a passive investment management. Now, there is a certain thing called the index. let's say there are different stocks available, for example, Infosys, Reliance, HDFC Bank, Tata Consultancy Services, so on. If you would know, there is something called a Nifty or a Sensex also. So these are nothing but indexes. Uh, you could just think them to be weighted average of a certain number of stocks, and it can be used to represent, let's say, the entire market as a whole, just as a benchmark thing. So in case of Nifty, it is basically composed of 50 companies where different weightages are given to different companies, and using aggregation of this, we come up with a particular figure, and it can be used to represent the entire market. Similarly, we have Sensex, which is basically composed of 30 companies. Now note that Nifty is basically for National Stock Exchange. Again, all this information which I'm mentioning is not directly relevant to syllabus. It's just for additional, let's say, general knowledge you might require. Sensex is basically for Bombay Stock Exchange. Now, we have an index over here, which is giving certain weightage according to a predefined formula, so on. Passive investing basically refers to the fact that you will invest, which is, let's say, going to replicate a particular index. Let's say I start with a management, I basically raise money from investors, which I'm going to invest. My intention is to replicate Nifty. So let's say Nifty different weights are being given to different companies. I will make a portfolio in such a way that it closely resembles that of Nifty. So let's say whatever returns Nifty is generating, my fund would be generating something similar to that. This is called passive investing in the sense that if there are any changes to the index, I will be blindly copying that. I won't be using my judgment as such. Whatever changes are happening to index, I am simply replicating it, and this basically results in that whatever returns the index is generating, my fund would be generating something very close to that. There could be so at certain points of time slightly higher or lower returns due to tracking errors, but generally it would be in line with the index returns itself. So passive investing is basically, you could think of it as buy and hold strategy. You buy something and then you leave it. You do not actively look at it, or you try to use your own, let's say, abilities to generate higher returns. Active management is where, using your own analysis, be it fundamental, be it technical, or be it anything, you feel that by being able to, let's say, actively buy and sell at a very frequent interval, you would be able to generate high risk adjusted returns. Often in markets, the term they use is alpha. Alpha is basically the additional return which you can generate over and above what a particular index is generating. So in active investing, what you do is you might be basically investing in stocks which you feel would perform better, instead of, let's say, investing in companies which are part of Nifty. I might be investing in companies which are not in Nifty 50 because I feel that they might be able to perform better compared to other companies. So this is, and I would be actively looking at them. When I say actively, doesn't mean every day. It could be on a weekly basis, monthly basis, quarterly basis. The fact is that uh, I would be relying on, let's say, my own judgment instead of the particular index. Now, if you are, let's say, into investment management, so obviously the costs involved are higher. Why? There is a higher frequency of buying and selling things. So there is transaction costs and taxes involved in that. Apart from that, you also need to pay a particular person. If a particular person comes and says that, I am using my wisdom or, my knowledge to generate higher returns from you. So obviously that person would be expecting what? Higher fees as well. So, in most of the developed markets right now, everybody is shifting towards passive investment because it has been shown that, using the actual data only, that using active management, very few can beat the returns of the benchmark. So if you're not being able to beat the returns of the benchmark, then there is no reason to give you higher fees for same. So, in passive investments, your typical, let's say, expense ratio could be 0.1 to 0.5%. Again, this could vary depending on which part of the world you're looking at. In case of active managed schemes, this could be as high as, let's say, 2% or 3%. Again, on the face of it, it might look lower, but this is something which is on a yearly basis. If you keep compounding it, this becomes a very high amount. So if, let's say, you're paying excess money to somebody, if that person is not being able to deliver you returns which are more than the market itself, there is no reason you would be paying fees to that particular, let's say, company or an individual. So, in recent days or in the recent years, there has been a shift more towards passive investment management. In India, I would say, before last 3 4 years, most of the mutual funds, if I talk about mutual funds, most of them were being able to generate returns which were more than Nifty. But in the last 3 4 years, majority of the funds which use Nifty as a benchmark, I guess almost 80 or 90% as per article I was reading, have basically underperformed. That is, the returns which they have given to investors is less than the returns which Nifty has given. So there is no reason, you could have directly invested in Nifty itself, where the charges could have been, let's say, 0.1%. Instead, if you're investing in a fund which is charging you, let's say, 2% and still consistently giving you returns which is less than Nifty, there is no reason for you to remain, invested as such. So passive investment is something which is garnering a lot of attention, a lot of traction in most parts of the world over the last couple of years or so. And even in India, a lot of the more informed investors are, shifting towards passive investment only. So, in nutshell, if you just want to understand, passive investment is, simply buy and hold, very less churning, very less buying and selling. Whatever buying and selling takes place is just to replicate whatever is happening in index. You might have a question, who determines the constituents of index and all. These are basically the stock exchanges. So let's say national stock NSE will determine how Nifty is constituted, which stocks to include, what proportion to give, so on. Again, there is a very predefined formula. It's not that they are just using any subjective or qualitative judgments. These are on basis of certain predefined parameters. Similarly, in case of Sensex, BSE is doing it. Then you also have other indexes, like we have the most common known would be, let's say, the Nasdaq, which is basically the list of all US listed tech stocks. Then there's Dow Jones, S&P 24, we have Nikkei, we have Shanghai, these are of Japan, China, so on, etc. So again, whichever index has this, they would be constituting the particular index. So your passive strategy is basically whatever things are happening in index, you just replicate that. And note that the changes which happens in this particular index is very infrequent. Like in India, in case of Nifty, as far as I remember, the changes takes place only twice in a year, at every 6 months interval. So whatever new shares might be become a part of Nifty, or if certain shares are moving from Nifty, these changes generally happen at an interval of 6 month period only. So this was regarding active and passive investment. Now the question is, why can active management not be justified according to EMH? More specifically, I would say, let's say, semi-strong from EMH. If markets are semi-strong from efficient, it means that what, using publicly available information, you cannot generate higher risk-adjusted returns. So active management relies on what? You are basically using certain information and your own judgment to what generate high risk-adjusted returns, but then that is something which is not possible in the place only. So you can just take a look again. Just keep in mind, how to come up and construct your answers. A lot of times you might know, or you might know in your head, what you're trying to write or communicate, but you're not being able to write it in words in a very concise manner. So just look at it, how they are framing the answer. According to the efficient market hypothesis, active investment management cannot be justified because it is impossible to exploit the mispricing of securities in order to generate higher expected returns. Because in the first case, we are seeing that the securities are not mispriced, they are priced according to all existing publicly available information. Even if price anomalies exist, then the costs of identifying them and then trading them will outweigh the benefits arising from the additional investment returns. On this, let me just come to a concept called arbitrage. Any idea what does an arbitrage mean? Ever come across this term, arbitrage? Gain profits. The whole fund is about profits. Okay? That is true. We will look at arbitrages in that only. As one of you mentioned, risk-free profit. Let me give a very simple example. I'll take this example. I've used it previously as well. Say a packet of Lay's chips. It's available at 10 rupees MRP. Okay. In a certain part of Calcutta, let's say Newtown, which is very far from Calcutta, the packet of Lay's chips is available for 11 rupees. Okay. Although the MRP is 10, but if you want to buy it, it will be available at 11 rupees only. Assuming that the shopkeeper is willing to buy chips from you as well for 11 rupees in, let's say, Newtown area. And let's say it is available at 10 rupees in, let's say, Elgin Road area. And you have a banya buddhi or a very businessman, you want to make money. You will come to the class, you will study, you will buy a lot of Lay's chips for 10 rupees. You can go back there, sell it for 11 rupees. This is an example of a risk-free profit. Why? There is no risk. What risk? First of all, I have made it clear. You can buy it for 10 rupees. The shopkeeper will buy it from you for 11 rupees. Let me also assume that, let's say your friend drops you home, so you do not have to pay for any of the transportation charges as well. There is no possibility of somebody robbing you of your chips in between. So you can just buy it for 10 rupees and you can sell it for 11 rupees and you make a risk-free profit. There is no risk involved. So an arbitrage basically means when there is an opportunity to make a risk-free trading profit. So now in this example, I told you can buy it for 10 rupees, sell it for 11 rupees. This is an example of what? An arbitrage opportunity. In real worlds, such opportunities do exist. But if a market is very efficient, in that case, even if these opportunities come, they get traded on very quickly. So if let us say if this is one example which one of you saw, okay, your friend might also see, he or she would also start doing that. Everybody will start doing what? Buying chips from, let's say, Elgin Road for 10 rupees MRP and selling at 11 rupees at Newtown, using the basic law of economics. If there is a demand increase over here, excessive high demand, it could be that the shopkeeper is now will increase the rate, since so many of them are coming and trying to buy chips and there is, let's say, a shortage of it. I would be willing to sell it at, let's say, 10 rupees 50 paisa. On the other hand, the Newtown shopkeeper sees everyone is coming and selling the chips to him. He has an excess supply, which will result in what? The prices to decrease. So that particular shopkeeper will now be offering, let's say, something which is less than 11 rupees only. At an equilibrium level, let's say it's 10.5 rupees. So at this point of time, you cannot make an arbitrage profit, right? So an efficient market, assumes that even in case there are arbitrage opportunities, these are traded on very quickly. So the moment even, let's say, one participant observes this, he or she would be trading on it so that very quickly that opportunity does not exist only. Secondly, like you gave the example. So the share prices of most of the companies get, you can trade them either on NSE or on BSE. And at certain points of time, the prices on both the indexes could be different. Let's say a particular stock, let's say talk about LIC only, it might be currently trading in NSE at 900 rupees per share. In BSE, it could be at 898 rupees. So you might think, let's buy from BSE at 898 and sell it to NSE at 900, and you can make a what? Discrete trading profit. How? On the same moment only you are buying from a, but let's say at the same point of time, using one system, you're buying from you're buying from BSE at 898, and at the same time you're selling at NSE for 900. You can make a profit. But the fact is, when you're buying and selling, there would be certain transaction costs. There are a lot of costs, be it something called STT, Securities and Transaction Tax. There is index fees, there are other fees, there is brokerage as well, and then there is GST over it as well. So there would be certain transaction charges. So let's say effectively the price which is being quoted on the screen is, let's say, 898, but the effective amount you end up paying is, let's say, 899.7. 1.7 rupees is nothing but, let's say, the transaction or the taxes charges. When you sell it at 900, this is the price which you're paying, but there would be again certain charges and taxes. So let's say after paying 900, the net amount which you will be getting of charges and taxes is, let's say, 899. So now clearly there is no arbitrage opportunity. Although on the face of it, price is 898 or 900. If you try to trade on it, your actual price comes out to be, in one case, let's say 899.7, and in another case it comes out to be 899. So effectively you're ending up making what? A loss only. So again, this is just to convey that if follow any stock prices, a lot of times you will see that there is a price differential between two. Still, for practical purpose, arbitrage opportunity does not exist because there would be transaction charges involved. So the moment you try to act upon it and try to make a profit out of it, that will not be the case over here. And at times, if even there is a case, in a very, let's say, efficient market, or in a very, let's say, I would say, a developed stock market, this would be happening for a very short span only, because nowadays there is a lot of algorithmic trading. So it's like all system generated, you have put in certain codes. The moment any such price anomaly is observed, automatically trades are executed, ensuring that within a fraction of a second or so, any such anomaly, if there, is traded upon and it no more exists. So you and me, or any normal retailers as such, will not be able to make any meaningful amount of money, because there would be already, let's say, algorithms there which you would be trading as soon as certain discrepancy is observed. So this was regarding passive investing as well as active investing. Moving further, how can we go about testing the efficiency of a market? If I want to test the strong form efficiency, I could look at the director's share trading. Obviously these are not generally available, but suppose if you can get this data, basically there's a director of a particular company, and I see the share trading patterns of it. Using that, if I see that yes, he or she is being able to generate high risk adjusted returns, then I can say that the markets are not strong form efficient, because the directors will be having privately held information, and if we see that they are making high risk adjusted returns, it means that the markets are not strong form efficient. So that is one way. Now, as per the actual past studies, the past studies suggest that even with inside information, it is difficult to outperform the market, suggesting that strong firm EMH hold. Again, these studies are based on mostly, let's say, UK data or US data. For different countries, it could come up with different conclusions. Next, legality of insider trading. Insider trading is banned in many countries, suggesting that the lawmakers believe that the strong firm efficiency does not hold in their strong markets. You would go and ban something only if you feel, if that could be used in a negative way. And if that can be used in a negative way, in this case, what insider trading, if you can use insider trading to make higher profits. And remember, if you are making higher profits, it is at the cost of somebody else only, in a way, because you had access to information. Let's say you bought a stock price, you bought a stock, right? Because the prices are going to increase, so there is a other person as well who is selling it at that price, who could be, let's say, a common investor. After 1 week, 2 week, when the results are published, the stock prices increase, I sell it at a higher price. The person who had sold it beforehand, he or she might not be making a loss, but is having, let's say, a kind of a opportunity cost, or not an opportunity cost, kind of a hype. What should be the term I should be using for it? Uh, क्या term बोल सकते हैं इसको loss के लिए? There's a particular term I'm not getting. Notional loss, basically. That had I not sold it at 500 rupees, if the prices would have 600, I could have sold it for 600. So let's say I'm making a notional loss of 100 rupees. So again, the common investor is suffering, basically, because he or she does not have access to that information. So this is regarding strong testing the strong form efficiency. So note that the studies of directors share trading, these are referring to specific studies. There could be alternative studies suggesting elsewise as well. In case you come up with any question, you can just say that basis the certain past studies, it might show that that the markets are in fact strong form EMH. They do hold strong form efficiency. Alternatively, when I look at the insider trading, most of the countries have mandate, which implies that the markets might not be strong form efficient, or at least the policy makers feel that the markets are not strong form efficient, and that is why they have banned insider trading. Next, what I have is testing from semi strong form EMH. This is, testing informational efficiency. I will come across it, what do I mean by informational efficiency? Testing for excessive volatility. This is something we will be covering right at the end of the chapter. Next, quickly just covering weak form EMX, technical analysis. So again, there are various technical techniques, technical strategies you can come up with. Most of the times it has been seen that using any one particular strategy hasn't delivered higher risk adjusted returns consistently in all different market scenarios. So using same strategy for let's say 10-20 years, you haven't been able to generate higher risk adjusted returns. So a very easy way to test, even if you want to test whether a particular stock price, or whether if you just want to talk about one particular stock, okay, you want to see whether weak form efficiency holds or not, you can, let's say, look at the historical chart of it. If you can come up with any trading strategy on the basis of which you can generate high risk adjusted returns, then it means that what? That it is not having weak form efficiency. And if you feel that no, you cannot make high risk adjusted returns, it means that it is having weak form efficiency. Now, testing informational efficiency. If a markets, now let me put it in this way, how should the markets react to any new news? If let's say markets are adhering to some form of efficiency, starting with semi-strong form, this is the form which where the most analysis is done. If a new information has been made available, and if a markets is semi-strong form efficient, the prices would be reacting instantly in the right quantum. Again, that is very subjective. We don't know what is the right quantum, whether it should increase or decrease by say 5%, 8%, 9%. We know that in retrospect only, but for the time being, it should react instantly to the news, accurately to the news itself. So on this, right. So when I was talking about semi-strong form, I was saying that the particular current market price reflects all publicly available information. First thing you should question is, when do you define that information made publicly available? See, it could be that, let's say financial results were released on 1st January. Okay, you can say on 1st January, this was made publicly available. What if there is some speculation regarding some merger? Like recently, again, if you are aware, Adani's are taking over Ambuja Cements. They want to buy that. So again, for the past 2-3 weeks, there was speculation that either Adani's could buy it, or Birlas could buy it, or Jindal, so on. You could think you already know previously 2 weeks back, Adani's are going to buy it. Now the fact is ki when do you decide ki this information has become publicly available? At the time it is officially confirmed, or even at times unofficially ki this is going to happen. So this becomes the first difficulty point, identifying the point when the information was made public itself. And if I don't know when this new information was made public, if I don't know that, then I cannot ascertain the time at which the prices should have reacted. So let's say if I will say that yesterday it was made official that let's say the Adani group will be buying the cements of Ambuja Cement and ACC. Yesterday prices increased by let's say 2 to 5% midday of both the companies, both Ambuja Cements and ACC. But what if you will see the last 2 weeks or so, let's say the prices have already increased by 20%. So now, if I say that the public information was made known today, then my increase is 2% only. But if I say that the public information was made available 2 weeks back only, then in the 2 weeks there has been 20% gain, which are generally very exceptional high gains in this short period of time. So now here the difficulty could be that if I say that it was 2 weeks beforehand, then I clearly see that this 20% increase wasn't a sudden increase. It has been increased over the past 2 weeks, which means that the markets are not semi-strong form efficient. Because if markets are semi-strong form efficient, they would be reacting instantly with the right accuracy. Let's say if instead of increasing 20% in 2 weeks, it should have let's say increased 20% within few minutes only. Again, you might think there are a lot of other factors. In general, if the markets are increasing, then the stock price could increase as well. I am just trying to alienate the fact that all the increases are coming due to this particular information only. Again, in practice, it is very difficult to ascertain, whether this increase is due to this particular information or this particular factor, so on. So, just to again make it a bit more clear, we will again doing some questions which will make it more clear. What should we expect if markets are semi-strong from EMS? If any new information comes in, the prices should react to it very quickly and at the right quantum, and it should not overreact or underreact. Overreact could be, let's say, increasing or decreasing at a higher or a lower rate, right? Underreaction could be like it is increasing at a very slow rate. And like, for example, this case only, instead of increasing 20% within a couple of minutes or hours, it took 2 to 3 weeks to keep the prices increasing. So next, what we have is overreaction to events and underreaction. So here I'll take a look at my PDF only. Before that, again, in a very concise way, you could look at this. This will help you to generate answers in a very concise way. So under informational efficiency, first thing which we are dealing with is the market for a particular security is said to exhibit informational efficiency if new information is incorporated quickly and accurately into the price of the security. The main difficulties is testing in testing informational efficiency are: first, it is empirically difficult to exactly determine when a particular piece of information becomes available to the public or anyone. It is difficult to judge exactly how and the extent to which the market price should react to a particular event. Let's say, for example, when lockdowns were there in March 2020, most of the stock markets crashed 40%, 50%, so on. So initially, everyone thought if COVID is happening, then prices should decrease. There are lockdowns happening, it's affecting economic activity, so on. But later on, what we saw in the next 1.5 years was an unparalleled increase. Like, for example, Nifty from a low of around 7,500, it touched highs of 18,500, and that is something we haven't seen that sort of return in such a short span of time for the last maybe 10 or 15 years or so. So again, nobody anticipated this. A lot of them thought markets would crash, world would get over, so on. It was probably the other way around, at least in form of markets increasing. Third is, it is difficult to determine what constitutes publicly available information. Again, certain things which come through documents that is publicly available information. But again, whenever there are speculations, like for a long time, there were speculations that Vodafone and Idea would be merging, maybe for certain months or so. So how do you know whether that is publicly available information or insider? You don't know. Many were speculating for 6 months, 9 months. So it's difficult to say whether that information is something known to some few people only or it is known to everyone else. Let's say another example, like if you have been following Elon Musk basically bought some shares of Twitter beforehand, right? And when he disclosed to the security exchange that he is holding, let's say 9% or so, a lot of them speculated that he might try to buy the company. For 1 week or so, everyone was speculating. Some thought he's just a, let's say, a silent investor. Some said he's planning to buy the company. Later on it came on, yes, he has made an offer to buy the entire company. So again, how do you determine whether Elon Musk buying Twitter was a publicly made information or not? Before it was actually let's say officially released by the company. You could say that the moment, given his nature, given the way he goes about his tweets and all, one could say that yes, he is planning to buy Twitter. Or you could say that why would somebody make such a large investment, especially if he or she is not a typical investor who invests in a lot of companies. So it becomes difficult to know what exactly constitutes publicly available information. Even right now, the Twitter deal has been kind of put on hold. So now it's very difficult to know whether the deal will be taking place or not. So if I say that the deal will be taking place, is that a publicly available information right now? We really can't say that. Even the management actually might not be knowing it. And last is how to adjust returns for risk and transaction costs. Empirical evidence, concerning informational efficiency. So empirical evidence suggests that markets do overreact to certain events and underreact to other events, and that over under reaction is corrected over a long period of time. If this is true, if let's say a particular stock is underreacting or overreacting, if this is true, then it means that you can make certain, let's say, high risk adjusted returns. For example, let me just give you an example. It is usually seen that if two companies merge, okay, then markets might feel very excited. If two companies are merging, there might be certain cost synergies, costs will get reduced, they might experience economies of scale, so on. So their stock prices increases quite a bit, but eventually it starts decreasing over a long time. So this could be an example of overreaction where you might overestimated the benefits of a merger, and then post actually the merger was done, the stock prices fell for a long period of time. Similarly, in case of demerger, wherein a particular company splits into two or more than two divisions, it is generally referred to as value unlocking in certain cases. Like just for example, which example should I take? Uh, in case of a demerger, the where prices increase significantly. Let's talk about this only. Adani Enterprise. 4 or 5 years back, there was just let's say one entity called Adani Enterprise. Later on, Adani, the shareholders of Adani Enterprise, let's say the company was segregated to different parts. One was Adani Green Energy, one was Adani Transmission. Probably Adani Ports wasn't there. It was primarily Adani Green Energy and Adani Transportation. So 4 or 5 years back, the value of one Adani Enterprises share was, let's say, 100 rupees or 200 rupees. And now if you look at it, the value of Adani Enterprises share is around 200, 300 possibly. But if you look at the other shares, Adani Transmission, Adani Energy, they have skyrocketed to 1000 rupees share, 2000 rupees share, which earlier was just, let's say, 30 rupees share or 40 rupees per share. So this is a classic example of value unlocking, wherein when you demerge a business, then individually their value increases a lot compared to when you look at them at a very, let's say, when you just add them up and see it at a, what to say, uh, at a collected level. There was one company having four different businesses together. They were getting a valuation of say X amount. If they are separated into different, they end up getting a far higher valuation. Again, these are due to various reasons. Point is that generally demergers are looked at. If there are demergers taking place, the management will be able to focus more on their particular line of business, leading to, let's say, better business management and higher profits eventually. So what happens is that initially when demerger is taking place, the stocks do not increase quite a lot, but over the period of time, a classic example is the Adani group of companies. In the last 2, 3, or 4 years, they have increased by probably 1000% or so. So this is an example where initially the benefits of demerger were not being visible, but later on we already saw that. So this becomes an example of, let's say, underreaction. So again, if we see that there is under or overreaction, if we are able to identify it, we can make higher risk adjusted returns. If I feel that demerging of certain companies should result in, let's say, the share price increasing by 3x, okay, and in fact the prices so far has increased by 10% only, I could buy those shares, wait for some point of time, because I know eventually they should be becoming, let's say, 3x of it. Similarly, if I feel that the share prices have increased a lot, it should not increase so much, and over a period of time, they're going to decrease only. I could sell them at a higher price, wait for some time for the prices to correct or reduce, and then finally buy it at a lower price. Then again, certain things are examples of overreaction and all. So there are different things, like as I keep mentioning, when try to plan whenever new curriculum is taking place or so on, whether to sit for this paper or not. One thing is, if the paper was difficult last term, if you will apply law of average, you could say that the next term the examination paper should be easy. Another thing could be, say there is a change of pattern, now the exams will be difficult only. So you will say next term the paper is gonna be difficult only. So both the things are there. Similarly, in case of stocks, if a particular stock has performed very well in the past, one side of the, let's say, investors could say that the stock has performed so well in the past. It has very good management. It has, let's say, very good business moves. It can make high level of profitability, and it will continue to deliver excellent returns in future as well. So again, I'm relying on what? Past performance. Because past performance was very good, I feel that the future performance will also be very good. Alternatively, somebody could apply law of average. Past performance has been exceptional. And it's like, or kitna बढ़ सकता है? Now how much more can it increase? So it's like, I would expect that the prices will eventually decrease, and vice versa. If a particular stock, a classic example was ITC, a lot of investors have been holding them for 7-8 years, and the prices were around 200 only. Everybody was like, 7-8 saal se it hasn't increased. Now, though, it will increase. Probably that now never came for a lot many years. So that was one case. Secondly, another case, a classic example was where, let's say, the prices were increasing and everyone was buying was. Which example should I take? Which increase and then decreased? A common example of that would be, you could, let's say, talk about Uber nahi. Chalo, let's talk about all these companies only at the aggregate level, be it Zomato, be it Nykaa, be it Paytm. So you can think of, when they come up with their initial public offerings, they sold these at a very high valuation. A couple of these kept on increasing because everybody thought it has increased, they will keep on increasing. And then after a point of time, what? It started to crash only. So again, what happens is key, because we thought they have been increasing previously, they will continue to increase in future, but rather they started decreasing. So it could be in either way. It could be that in the past the values were decreasing, you expect them to increase, or it could be the other way around as well, where if you feel that a company has grown in the past, it will continue to do so in future as well. Then next thing is, certain accounting ratios appear to have prediction powers. So an example of this is, if you would be aware of something called, let's say, price to earnings ratio. Just go by the term itself. Let's say if the company is earning 1 rupees per share and the price of one share is 20 rupees, then the price to earnings ratio simply becomes 20 by 1, which is 20. Similarly, if I say a price to earning ratio of 50, it means that for every 1 rupee which the company is earning, somebody is willing to pay 50 rupees for it. Now, it has been seen that if a company has a very low price to earnings ratio, it might do very well in future. Why? Because what we're saying is, if a company has very low price to earnings ratio, it effectively means to earn 1 rupee, you need to pay a very low price for it. So you might feel that the investment is more attractive in nature. That is one. Alternatively, you might feel this is undervalued, and so the prices could increase. This is one side of the story. Second side is, similarly, if a company has a very high P, let's say, if I talk about these consultancy services like, IT companies, TCS, Infosys, Wipro, Excel, so on, these generally right now have around 20 to 30 PE. So let's say if I talk about TCS, right now it probably has a PE of 30. So for every 1 rupee which TCS is earning, investors are willing to pay 30 rupees for it. Now, some of them might feel this is very high. This should not be the case given its growth prospects and so on. Now, the point is, if it is having a high PE, it could be due to a reason. It could be because, let's say, the profitability is very stable, or it could also be in anticipation of what? High growth. When would you be willing to pay a high price? What would be the common logic? When would you be willing to pay high price for something? If it's for investment, you would think that its price will increase, right? Now, generally, price will increase when the company is growing. It could be either in terms of revenue, profitability, anything. Alternatively, you will be willing to pay high money when, if you think that the particular thing has high value. This is in case of non-tangible things. Let's say you want to buy a particular कोई artifact ले लेना है, some painting लेना है, or let's say you want to invest in a particular course or in certain education courses, whether you want to do MBA or not, whether you want to spend, let's say, 1 crore doing an MBA or not, you will be willing to do it only if you find that valuable. Maybe not monetary wise, but maybe in otherwise as well. So certain times, what they say is, certain analysts will come and say this company has a low price to earnings ratio, you buy this will do well. This is again assuming that the company maybe hasn't performed off late well in the past. That is why the prices are low, and it was going to perform well in the future. So it might seem that certain accounting ratios appear to have prediction powers, but then that is not the case. So generally, what happens, a very high growing company will tend to have a high PE. And if a company is a very high growing one, it is expected that its profits are going to increase, and then its prices are also going to increase in future. So just because this company has a high PE, and on that basis you buy and say, I was able to interpret using my own judgment, that is not the case. It is having a high PE due to certain reason, and it might continue to have high PE going forward as well. Similarly, a company which has a very low price to earnings ratio, a part of the reason could be that the company is not performing well. That is why the prices of the shares are very low, and it could happen that for a very long time the price to earnings ratio remains to continues to remain lower only. So this is one part. Again, the essence was the ultimately we're reacting what to the past growth only, whether it was low growth or whether it was high growth. Then this one again, this is a very important thing. Firms coming to the market by initial public offering or seasoned equity offering. In our Indian market context, what we have is initial public offering only. They have poor subsequent market performance. Like this has been observed in US and UK. If you will think in this way, what happens in initial public offering is a company either issues new shares or the existing shareholders sell their own shares. Let me just focus right now when the existing shareholders are selling their shares. Just think that you are there. When would you would want to sell your shares? When you would be getting a very high price of it. So generally, when there is a lot of, let's say, excitement in the markets are at peak. Let's say in the last, just before last, 3 to 4 months back and all, in the last year there were a lot of IPOs coming because money was easy, the markets were rising, and the investors, everyone were willing to pay high money because they felt that they can make high returns consistently. So now, if I have a particular business compared to you all, I would have more idea about my business. If I am coming and selling my own shares, I will only do that if I feel that the price which I'm getting currently is very high, and that might not be the case in future. Or I feel that even in future the price is increasing, the rate at which it will increase will not be that high because the current value of the shares are only very high. So that is why a lot of investors or lot of reputed let's say long-term investors say that never invest in an IPO, especially if the existing shareholders are selling. Because if somebody else is selling the shares, then why should you buy it? Especially if the owners of the company are, or the current investors of the company are selling the shares. So it has tend to be seen that whenever in a particular point of time high IPOs come, it is followed by a poor performance in the market. This had been the case in 2007 and 8 as well, during 99 2000 dot-com bubble, and even in fact you see probably last year or a couple of years back, Indian companies raised the highest amount of money through IPOs, and basically for whatever reason we ultimately followed up with what negative returns only. So this is another case. Next, examples of underreaction. Stock price continue to respond to earnings announcement up to a year after their announcement. So basically the prices are increasing or decreasing whatever at a very slow pace for a continuous point of time, trying to digest whatever the earnings announcement were. Next is abnormal excess returns for both the parent and subsidiary firms following a demerger. Already an example I've talked about. Abnormal negative returns following merger. Again, I have already covered this example. And then again, other examples of pricing anomalies. Example, the ability of accounting ratios to indicate outperformance are proxies for risk. So just for example, a company having a very high price to earnings ratio. These are generally very high risky companies because we think that these companies are going to have a very high growth. But what if they do not have very high growth? It becomes very risky in nature. So any sort of new based companies, you can talk about, let's say, companies dealing with cryptocurrencies, or companies dealing with right now, let's say, metaverse, or any new fancy thing which comes up in the market, which are not time tested. You don't know whether people can make money out of this or not. So these tend to be very high risk in nature, and certain accounting ratios might appear to show them as very favorable or not, but these are nothing but basically proxies for risk only. So generally, again, just for market knowledge wise, companies which tend to have a high PE, they are generally more riskier. Companies which tend to have a low PE generally are seen as less riskier. Simple thing is कि भाई, if you need to pay 8 rupees to earn 1 rupee, that is less riskier compared to paying 40 rupees to earn 1 rupee. Again, in reality, it could be that where you pay 40 rupees, you end up making more money, and where you pay 8 rupees, you make up less money. That's a different thing, what happens or not. On the face of it, if you pay a lower money and you get the same value, that looks as a less riskier option. Finally, what we has is the volatility test. So there was basically economist probably named Schiller who basically did volatility test. Are you all aware what volatility means? Market volatility. Another term for variance. If I say markets are very volatile, it means markets are increasing or decreasing whereby a very high frequency. And generally, again, if there is high volatility in market, this is generally during times when the markets are falling. When markets are rising, these are generally not that volatile. But technically speaking, volatility basically means the frequency of up or down movement, frequency as well as the more so the quantum of it. So in a very highly volatile market like right now, what you will see is one day Nifty is increasing by 1%, next day it is decreasing by 2%, so on. Otherwise, if you would look back at 2019 or so, such wasn't the frequency. You will see maybe 0.3%, 0.5% upward downward movement, maybe continuous upward movement for a month or so, so on. So right now the markets in general are very volatile. So now, this Schiller basically came up with a proposition that, uh, let me just read it out once. The claims of excessive volatility was first formulated into a testable proposition by Schiller in 1981. He considered a discounted cash flow model of equities going back to 1870. So right now you all must be aware what a discounted cash flow model is. So in case of valuing an equity, what you could do is, if you buy an equity, you generally expect to receive income in what form? Two forms. One, usually in form of dividends. Another, when you sell the share in form of capital gain. There is something to do with buybacks and all as well. Let's ignore that for time being. And mostly, let's say if you want to be an owner forever, you would be getting income in form of dividends only. So in discounted cash flow model, what I do is, if I need to find the correct price of a share, I will try to model or forecast the future dividends, find the present value of it, add them up, and then there is also something called a terminal value. Like let's say when you sell a particular share, or let's say if the company stops operating, what would be the left out value of the company? This is, let's say, being referred as a terminal value. Using this, I can come up with an estimate of the correct value for the particular share. Okay. So now by using the actual dividends paid and some terminal value for the stock, he was able to calculate the perfect foresight price, that is the correct equity price, if market participants were able to predict future dividends correctly. The difference between the perfect foresight price and actual price arises from the forecast errors of future dividends. So I'll give you just one example, what I'm trying to do over here. Let's say the terminal value of a particular stock is 50. As of today's date only, I expect dividends of amount 2, 3, 4, 5, so on each year, with the first dividend being paid after 1 year. So now I can say that the fair value or the correct value will be, let's say, 50 plus 2 divided by 1 plus I plus 3 divided by 1 plus I whole square plus 4 divided by 1 plus I whole cube, so on. This will give me a theoretically correct price, which is P. Okay. Now in future, this is, let's say, the price at time 0. At time 1, I can again perform this thing and I can get what should be the correct foresight price. Now the actual price at time 1 will be different only if there is a difference in the dividends also. Let's say I had assumed a dividend of 2, 3, 4. After 1 year, instead of 2, I actually got a dividend of how much? Let's say 4. And Other dividends, let's say, are assumed to be 3, 4, so on only. So whatever difference in the actual price would be there will be due to the differences in the actual dividends received only. So this is what he proposed. He whatever changes, in the actual price. Let's say the actual price was 100, okay, and the correct price which he thought was 120, supposedly. After 1 year, if the actual price is 102, ideally this price should become, let's say, 122. The difference I am saying should be of same magnitude only. So this is what he proposed, and using this, what he was trying to do was calculate the volatility. So the difference between the difference between the perfect foresight price and actual price arises from the forecast errors of future dividend. If market participants are rational, then we would expect no systematic forecast errors. Also, if markets are efficient, broad movements in the perfect foresight price should be correlated with moves in actual price, as both react to the same news. My actual price should increase when, let's say, if there is an increase in dividend or a decrease in dividend, and my foresight price should also be changing to reacting to the same news only. So let's say the direction as well as the quantum of the movement of the actual price as well as this forecasted price or the foresight price should be same only. Now what he did was here, if he applied this model, he expected that the volatility of the stock price should be, let's say, A. But in reality, in market, what he observed was it was far greater than A. So this is the whole concept in the volatility test. According to this model, he expected that the volatility in the stock price, let's say, should be of 20% per annum. In reality, what he observed was it was, let's say, 35% per annum. So which is basically contradicting my which assumption that the markets are semi-strong from efficient. If my markets are semi-strong from efficient, they should be reacting in the right quantum to any news. But if I'm saying that there is more volatility than expected, it means that the markets are what kind of overreacting to it. Whatever news is coming, whether good or bad, the increase is very high or low, leading to high volatility, which is basically, what uh, contradicting my assumption that the markets are semi-strong from efficient. And finally, there were few criticisms of Schiller's methodology. These were with respect to the choice of terminal value for the stock price. Again, whenever you come up with the model and whenever, especially in higher papers and even work price, you want to see why things did not happen the way you thought it to be. Just take whatever you're writing down. End of the day, you're ultimately assuming everything. So, for example, I assumed a terminal value of 50. So this choice could be, subject to a lot of discussion whether this is the correct or not. How did you come up with this? So on. Next is my assumption of dividends. How did you come up with this? Next thing you will observe is I have used a constant discounting factor. Alternatively, it could be that 1 year discounting factor should be at a different rate. 2 year factor should be at a different rate. Basically, I should be using a yield curve that is for different terms. I should be using different discounting factors, so on. So this is it. These are the four criticisms which came. Going to the material itself, again you'll find all of this. There's a section on overreaction of events. Then we also have a section on underreaction, I guess. Yes, overreaction is there. These are the anomalies it's given there. Volatility test is basically Schiller's volatility. This covers the vast. Yes, so in the conclusion one, this question we'll just go through once. An investment market is strong from efficient. Describe what would happen to the price of a company's share if some positive information about the company becomes known. Read the question again, see. What should happen? No change, and quantum change. Read what is there in the bracket. See, it's a new information. Remember that whether it's strong form, semi-strong form, or even weak form, prices need to react to new information. That is fine. That is not, what to say, contradicting my assumption of efficiency. It is, in fact, if it doesn't react to a new information in the right way, then it would be contradicting the form of efficiency. So ideally, I would want what? The prices should react instantly to it in the right quantum, whichever way. Here, if there is some positive information, I should expect what? It should be increasing only in the right quantum. So the share price should go up ideally. This should happen immediately. The share price should rise without bias. That is that the market does not overreact or underreact. So basically two things, it should happen instantly and it should happen at the right quantum. Direction is something that is question specific. If it is positive, you would expect it to increase. If it is negative, you would expect it to decrease itself. This question as well. Next one. With reason. True. Semi-strong from March suggests will beat the market in the long term. What about others? True. That is.
We know the past data and publicly.
Short term ठीक है एक चीज सी what all others are getting false ठीक है what's the reason Siddhi? You can unmute yourself and ask rather say
I am not sure about the long-term aspect, but yes, since it's a semi-strong form of market, a person who possesses insider information may use it to exploit and beat the market. But I'm not sure if it will work in the long term or not.
ठीक है now again this is why I said this chapter at the face of it might become consuming. You need to understand first of all what does semi-strong form means. Semi-strong form means that the current prices incorporates all publicly available information. One. Second, another thing which I would like to say is using fundamental analysis, you cannot generate adjusted risk adjusted returns. Okay. Now, in reality, here it's a new investor. If there are thousands of investors, by virtue of just sheer luck, some investors will be getting returns which are higher than market. Some investors will be getting returns which are lower than market. So this statement is false. Some of them inherently will beat by virtue of sheer luck. Not system. Here it's written no investor. If there are, let's say, crore investors in the market, few investors by sheer luck only would be getting returns, even in long term, which are more than the market. Exceptions will always be there. Similarly, there will be investors who will be getting returns which are less than the market. And here, first of all, there is not even any mention of high risk adjusted returns. By sheer luck, 1 in 1,000 case तो भी सकता है. It is fact. Exception तो आएगा ही. तुम 20 as you take any person. अच्छा, I will give example. ठीक है. नॉर्मल है कोई, अरे तुम मार्केट रिटर्न इफ यू सी सपोज ठीक है कोई निफ्टी में इन्वेस्ट किया था 1990 या 2000 जब भी आया था, आज से उसका ग्रो के पता नहीं कितना 70 टाइम्स हो गया होगा। इफ somebody had invested just in Infosys, उसका तो उससे ज्यादा हो चुका है, वो तो ऑलरेडी रिटर्न बीट कर चुका है मार्केट को। there would be some or the other investor ना, कोई नहीं नॉर्मल। if you practically if you see some you know let's say a particular parent just passed on the shares to his or her daughter, उसको पता ही नहीं, डॉटर और सन चलो जो भी हो, उसको पता ही नहीं वो शेयर्स क्या नहीं है, बस पड़ा हुआ है। अब वो देख रहा है आफ्टर 20 years इट हैज जनरेटेड रिटर्न्स व्हिच आर मोर देन द मार्केट, तो वो तो हो ही सकता है, वो होता है इनफैक्ट। इसमें ये नहीं कि सिस्टमैटिकली कर रहा है, वर्डिंग्स देख लो, नो इन्वेस्टर विल बीट द मार्केट, ऐसा नहीं है। इट इज पॉसिबल शॉर्ट टर्म लॉन्ग टर्म, इट इज पॉसिबल कि somebody could inherently beat the market, एक या दो जन होएगा, 10-15 जन हो, randomly there could be possibility
strong market view.
in any market. Actual results can be different. It is like saying you have prepared everything still you fail in the exam. Say 10 लाख लोग एग्जाम दे रहे हैं, हो सकता है वो एक जन फेल कर ले रहा है, even if the person knows everything, कंप्यूटर बंद हो गया एग्जाम का समय। That is the thing. That is due to just sheer luck, not due to his or own better decisions। ये नहीं कि that person is starting up। Actual होना is different from expected. That is the point. When I say ना consistently तुम generate कर नहीं सकते future में, you cannot give that assurance. That is one thing. You actually get higher returns is another thing. मैं आके तुमको बोलूँ तुम probably will get 100 only every year, ठीक है, गारंटी देना is one, that is wrong। किसी का आ जाए, आ तो सकती है, आने का तो कुछ नहीं आ सकता, तो that is the same thing, somebody will beat, that is the whole thing। if अगर ये statement ऐसे रहता, the semi strong form of EMH suggests that you know, so कैसे है, suggests that no investor will beat the market in the long run, suggests that some investors suggests that इसको अगर ट्रू बोलने का है, इसको कैसे, if I want to make this statement as true, maybe the semi strong form of the EMH suggests that most तो चलो ठीक है, नहीं most नहीं, मतलब एक और no investors guarantees ले लो। The semi strong form of EMH hypothesis guarantees that no investors will beat the market in the long run। नहीं, guarantees तो क्या है नहीं, for guarantee कर नहीं सकता। नहीं, ये स्टेटमेंट फिच करके तो वैसे नहीं होगा, ये पॉलिसी रिलेटेड। इट इज लाइक कि फ्यूचर में यू कैन नॉट से इट, लाइक देखो रैंडमली किसी का हो गया अलग चीज है, यूजिंग दैट सेम थिंग। अभी तो चलो इन डिस्कशन वी डोंट नो इवन द रीजन, पॉइंट इज यूजिंग द सेम सेट ऑफ टेक्निक, इफ यू कैन जनरेट then it would be defined, otherwise it's not defined। बाकी random luck will always be there। no investor, right, means कि no investor ऐसे most हो सकता है, you could still have said हाँ true है, most investors will not beat, that is true। no के जगह most करोगे, ठीक है, that is true। but here if we consider sheer luck, it will be an assumption, नहीं तो it is, outliers are a part of data again। when we are looking at large sample sets, outlier is more of a kind of a rule only। And here again in a mathematical way, the laws of probability suggest that some investors will achieve returns in excess of the market even over the long term purely by chance। Like इसका था Slumdog Millionaire, he got all कितना 10-15 correct questions and according to him all was क्या by chance only। again वो movie made है, ठीक है, real life में भी I can give you my example। one of my relatives she just looks at the, let's say, numerology and she sees whether the today price of stock will increase or not। so for 2 years she made lot of money, in last 4 months सब loss में चला गया। so maybe for those 2 years you could say that, you know, even if that is long term, she was able to, let's say, defeat the returns in the market, but eventually she couldn't। so again ठीक है, वो 2 years तक तो था, some of them could even do it for, let's say, 10-20 years, so on, maybe just by sheer luck। and there will be one person who would be getting things just out of, let's say, sheer luck only। you will think about a person who is the child of Elon Musk, that is just sheer luck। being born to the wealthiest person or not, that is sheer luck। भाई 700 करोड़ लोग हैं, एक जन फिर भी हुआ ना वहाँ, sheer luck हो गया, that is the same thing over here as well। again to frame your answer, the second part of it. However, the efficient market hypothesis suggests that no one will be able to do systematically unless they accept a higher level of risk than exhibited by the market as a whole. So again, an investor here only, I can systematically generate more returns in the market, but then I would be inherently taking higher risks. So यहाँ पे beat the market in long term, and that is also not very clearly defined. What do I mean by beating the market? If it is just, let's say, getting a higher return than market, that is possible. Higher risk adjusted return on a systematic basis, that is not possible in a semi strong form or even in a strong form. Or they have inside information. Semi strong form hai, so if you have inside information, in that case you could consistently get higher risk adjusted returns compared to what the market delivers. हाँ, मतलब इसमें it is more like कि this is false. Now you are saying when it could have been true, and in certain questions you can say anything by A be true, A be false. And like I said now, if the company has performed well in the past, you can give both reasons कि why it can perform well, why it can perform worse. Bad का बोलोगे it has performed so well, there is no further scope to perform for whatever business reasons. Let's say right now, like Zerodha, they made around probably 1600 or 17 crore of profits. And the founder is very good in the way he's saying that we made this much money because the markets were up. If markets are down, we're never going to make this amount of profit. So वो तो बोल रहा भाई we performed this well, there was a very specific reason, it might never happen again. Consequently, somebody could just extrapolate and say, last year we made 1000 crore, this year we made 1600 crore, next year again we multiply by 60%, we might make, let's say, 3000 crore. After some point of time 10 lakh crore जो भी चलता रहेगा. तो you can give any reason. Reality में क्या, और हम लोग देख ही नहीं रहे. Point is कि consistently can you get every time right? And again, one person might get it, but again that is just by, let's say, sheer luck. Nobody can guarantee कि हाँ by using this technique I would be definitely getting it. So this is we have in the chapter. A question we'll do was 1.1. All of you do give it a shot. Basically need to comment if the market is having any form of efficiency or not, and the reason for same. Question 1.1. Annual market returns in consecutive years have negative correlation. What does this imply? Efficiency पे क्या है, तो क्या है या नहीं है, क्या पता चलता है? Negative correlation मतलब 1 year if you have positive, next year negative. So इससे can you infer something? If last year I had positive, then this year there is a chance of getting negative. So using past history, I can what? Predict future. So this is what saying that market is not even weak form efficient. If I found any sort of correlation apart from zero, if there is positive correlation, it implies markets are not weak form efficient. Why? If last year's returns were positive, this year also returns should be say positive. If last year it was negative, this year it is negative. So point is using my historical information, I am being able to generate higher risk adjusted returns. Higher risk adjusted caise, I know there is a very high probability or almost a certainty it would be happening in this way. So even by taking the same amount of risk, I can generate higher returns because let's say odds are in my favor. Or negative correlation means if last year it was positive returns, this year it could be negative. Here also I can make higher risk adjusted returns because I know what would be the expected, let's say, direction of the market. And this could be an example of, let's say, overreaction. If there is negative correlation means 1 year it is increasing, next year it is decreasing. So you can think in this way, when it is increasing by far more it should have. That is when the next year it is decreasing. Alternatively, you can think as if 1 year it is decreasing by a higher magnitude than it should has. and that is when the next year it is again increasing. पॉजिटिव में अंडर ओवर रिएक्शन है कि ज्यादा इंक्रीज हो गया तब नहीं होगा. हाँ, could have said that positive correlation. Next, B should be more easier. Once who are in online session, feel free to unmute yourselves. Fridays, there the values are 1% higher compared to Mondays, right? So you buy on Monday and sell on Friday. So again, this implies what? It is not weak form efficient. हम लोग बेसिकली टेक्निकली एनालिसिस यूज कर रहे हैं. टेक्निकल इसको हाँ मतलब हाँ वी आर यूजिंग पास्ट डेटा ओनली ना. इट हैज बीन फाउंड यूजिंग हिस्ट्री की 1% है. देन थर्ड, it is taking more time to it is not semi form efficient. It could be weak form, we can't comment वो नहीं कर सकते, but it is definitely not semi strong form efficient. And remember, if something is let's say not weak form efficient, it is कोई सा भी नहीं. If something is not semi strong form efficient, it is not strong form also. But if something is not semi strong, we cannot directly conclude ki whether it will be weak form or not. That needs to be same. Last, insider and overreaction. ओवररिएक्शन बोल सकते हैं. फेवरेबल अनाउंसमेंट तुरंत घट गया. नहीं, ये this implies कि strong form efficient नहीं है. If on a positive announcement if prices fall, this will generally happen if insiders have taken a position. They have taken a position, they have sold it at high levels, या फिर जैसी positive है they have sold it and which leads to a result fall in the prices. Or more so you could think in this way कि let's say today the share price is 200. I am an insider, I know price something good is gonna come up. I start buying it in the next 1 month from 200 it goes to 300 because I have started buying it and you know there is more demand of shares so on. As soon as the favorable news comes in, I start selling my shares. So let's say the share price becomes 260. So as to 200 से 260 but I have made my profit over there. But the point is क्या कि 300 से 260 हो गया. It means क्या कि शुरू में the 300 was not the let's say the correct price at that point of time. As to know how to express your answers, which is quite important in this chapter. बोल जा करो, मुझे पता नहीं चलता है यार. So third part, like more precisely, if the semi-strong form of EMH holds, public dividend announcements should have an immediate effect on the share prices as the market should respond quickly and accurately to new information. This observation suggests that the market is not semi-strong form efficient. Next, prices fall following a favorable announcement. The prices are reacting when information is made public. This suggests that prices have previously been distorted by insider information. Therefore, this observation contradicts the strong form of the EMH. And ultimately, they have just made it clear that once a particular form of EMH is contradicted, this also contradicts any of the stronger forms. If weak form is not there, it implies that semi-strong and strong form is also not there. So this is all we have. Any doubts from this chapter? Again, go back home just to see, because the whole crisp is ki what are three forms of efficiency and what do you expect out of it, which might take a bit of time for all to understand ki what should we expect if a particular form of efficiency holds, what sort of responses will be adhering to a particular form of efficiency or not adhering to a particular form of efficiency, so on. Others once attending the live online class, any doubts, or should I wrap up the class? Don't have a doubt, kindly put a no in the chat box and no. Okay, no doubts. Then we'll wrap it up over here. Thank you, everyone.